Teddy Roosevelt 2019 is not monetized. Please like, subscribe, and share so more viewers will see this information.
It's a 1-year membership in the Jelly of the Month Club.
Over the last 30 years in the USA alone, the top 1% has grown $21 trillion richer, while the bottom 50% have grown $900 billion poor, a pattern of widening inequality.
The subject of this video is how to raise wages for workers without raising taxes on the rich. We once did it from 1933 to 1972. Workers' wages nearly tripled.
I don't know how tasty that would be.
But I do want to speak to this because it was a subject that we did not raise, which is the idea that the problem will be solved with taxation. This is not true. The trillion, at least in the American economy, the $1 trillion elephant in the room is not raising taxes on rich people a little bit more. It is the transfer of wealth which has taken place over the last 30 years from workers to owners. In 1980, actually from 1950 to 1980, American corporations had about a 6% profit as a percent of GDP. Today, it's 12 or 13%. In the intervening period, labor as a percentage of GDP went down an identical amount. That's $1 trillion.
Just take a look at recent history. In a 1966 article, Time magazine, looking ahead toward the future, and what the rise of automation would mean for average Americans. That's what the article was about. It concluded, by 2000, the machines will be producing so much that everyone in the U.S. will, in effect, be independently wealthy. With government benefits, even non-working families will have, by one estimate, an annual income of $30,000 to $40,000. Now, that was in 1966 dollars.
That bold prediction calculates in today's money to $191,000 per year.
How to use leisure meaningfully will be a major problem, wrote the article. The premise was simple. With better technology, companies would become more efficient. They'd be able to make more things in less time. Profits would skyrocket, Americans would bring home higher and higher paychecks, and all the while working less and less.
In 1966, economists were predicting that in the future, American workers would make over $100,000 per year. Well, obviously that has not happened. Why were they so optimistic? From 1933 to 1950, the average worker went from $7 an hour, as shown in the previous graph, to $11 an hour, as shown in this table. That was from $14,000 a year to $22,000 a year. 22 years later, wages nearly doubled. They went to $40,000 a year, or $19 an hour by 1972. And in 1966, the expectation was that trend would continue. The subject of this video is, where did the money go?
The typical male worker in 1978 was making around $48,000, adjusted for inflation, while the average person in the top 1% earned $390,000. Now fast forward. By 2010, the typical male worker earned even less than he did then, but the person at the top got more than twice as much as before. Today, the richest 400 Americans have more wealth than the bottom 150 million of us put together. Now think about it. 400 people have more wealth than half the population of the United States.
Well, as a consequence of that thinking, over the last 30 years in the USA alone, the top 1% has grown $21 trillion richer, while the bottom 50% have grown $900 billion poor.
Chevron, Starbucks, Qualcomm, and Apple, just a few of the names of companies announcing big share buyback programs along with their earnings reports. Apple hitting $1 trillion. A part of that thanks to the initiation of buybacks at that company. This is all part of the growing phenomenon, according to new research, that could be, quote, starving the economy. Adding, quote, stock buybacks are eating the world.
United States this year, American corporations will devote 54% of profits to stock buybacks, which is simply companies generating stock price increases by retiring their own shares. It's this unbelievable Ponzi scheme, which consumes now $700 billion in our country per year, 4% of GDP. 4% of GDP is now being devoted to stock buybacks to enrich a tiny minority of people.
Teddy Roosevelt, 2019, has an economics degree, but even for me, a number like $700 billion does not mean much. If $700 billion per year is going into corporate stock buybacks, how much is that per household? Well, Bureau of Labor Statistics data shows that's $8,423 extra would be available for household income if stock buybacks were illegal today, like they were from 1935 to 1982. So it's $8,423 extra available per household, or $4,268 available extra per worker.
And that's the big problem, right? So whether I pay 35 or 45% tax rate, it's totally beside the point. The much bigger opportunity is to raise wages, for instance, via the minimum wage and other mechanisms, and lower the share of the value created by enterprise that goes to owners and executives, and increase the amount that goes to workers.
Sandy, you really think that the popularity of buybacks is hurting this economy? Can you explain?
Yeah, it's probably a pretty complicated phenomenon. But you had corporations spending roughly $7 trillion on buybacks between 2004 and 2014. They're currently spending hundreds of billions of dollars a year on buybacks. And to a certain extent, that might be reducing corporate investment. That might have downstream effects on productivity, on GDP, and on wages. This is a relatively new thing. It's the subject of a lot of research and a lot of debate. But nevertheless, obviously, the movement from providing things like dividends to buybacks seems to be having a broader macroeconomic effect, both in terms of wealth and in terms of other important numbers.
Senator Chuck Schumer and Bernie Sanders, are calling for a limit on corporate stock buybacks. In a New York Times opinion piece today, they argued buybacks have led to enormous income inequality and are bad for workers.
As an econ teacher, I'm very concerned with lack of wage growth for workers and economic stagnation for the middle class. This January, Democratic Senator Chuck Schumer and independent Bernie Sanders proposed doing something that would be great for the American worker. They want to regulate corporate stock buybacks, as we did from 1935 to 1982. Before 1982, corporations could not buy back their own stock off the stock market. This meant corporations could do 5 things with their extra yearly profits. They could put the money in the bank to invest later. They could invest in expansion or new equipment for their current facilities or business. They could buy a competitor and expand that way. They could increase the dividend they pay to their shareholders, or very frequently, a percentage of the extra money corporations had on hand would be used to pay an annual bonus, usually around Christmas time.
What the hell do you want? My bonus. Oh, I was gonna wait till tomorrow to tell you all this, but what the heck? With this bonus check, I'm putting in a swimming pool. Hey.
Honey, it's bigger than you expected? Smaller? What is it?
It's a 1-year membership in the Jelly of the Month Club.
You'll get nothing and like it.
It's a 1-year membership in the Jelly of the Month Club.
It's all there, black and white, clear as crystal. You get nothing. You lose
Good day, sir.
Or very frequently, a percentage of the extra money corporations had on hand would be used to pay an annual bonus, usually around Christmas time, or the money could be used to increase employees' wages. American workers' wages basically tripled from 1935 to 1973, in part because corporate stock buybacks were illegal.
And they cite some statistics. Something like 80% of all profits have been poured back into dividends and buybacks, and they say that's a bad thing, right?
Yeah, they want to limit these stock buybacks by forcing companies to invest in workers first. They say that buybacks are making income inequality worse because they benefit shareholders and executives instead of workers. 2018 was a record year for buybacks.